as a mortgage lender, a lot of consumers think that somehow we're controlling the rates, or that we're, committing thievery, or or that there's some kind of I don't know, deceit. I am Brandy Whitmire. I am a mortgage lender, a banker, broker, direct lender. We do all the conventional loans, FHA, VA, USDA, except for right now, USDA with the government shutdown, we're not able to do USDA right this second. But basically every product in the sun. Last week I talked about jumbo loans. I like big loans, and I cannot lie. And anything that you can think of. If you have any real estate questions, any mortgage questions at all whatsoever, anytime, always reach out. Direct message me, write a comment here, email me, bwhitmire@financemyhome.com, and I will be sure to help you. So this is episode 31, which is awesome. And today I'm going to talk about a subject that's kind of sensitive. It's probably one of the most sensitive subjects that I have with borrowers, or sensitive conversations that I have with borrowers, because as a mortgage lender, a lot of consumers think that somehow we're controlling the rates, or that we're, committing thievery, or that there's some kind of I don't know, deceit involved with it, which it's not. As a mortgage lender, I'm not controlling the rates, right? There's a rate stack, and you choose from that and whatnot. And of course, there's different rates in the stack. But anyway, it gets kind of sensitive because, I'll give you an example. Like yesterday I quoted a client 4.25% on a loan. Today he came back and said, hey, yes, let's do it. I'll move forward. I want to do this deal. And it was 4.375. And he's like, well, why isn't what you quoted me yesterday? I'm like, well, rates change daily. I've seen rates change 3 times in one day, because as news comes out and as the economy moves, we could have a pricing change for the worse or for the better. It's not always it's not always going up, right? It goes up, it comes down, it goes up, it comes down. Of course, it's only a sensitive topic whenever it goes up, right? Whenever it goes down, like I'm the best thing that ever lived, and I'm the best thing that ever happened when I didn't do anything. It's the economy. The economy shifted, so therefore the price of that loan changes. So I'm going to give a basic rundown on how interest rates work, okay? What affects the rate on a big scale, which we won't get into all of that, but just so you know, anything that produces fear is going to affect the rate. If there's war, anything political, a new president in office, unemployment, which we'll talk about more specifically, anything, corporations going out of business, oil going up or down, anything that you can think of can affect interest rates, right? That it will go up and down, because when people get scared, when investors fear, or when investors think that the consumers are the people are going to be scared, they're going to take their money out of investments. And when money comes out of the market, out of bonds and out of stocks, then you're going to see rates go up, because they're making up that money, right? So that's a big overview. A lot of things affect an interest rate, but I want to get down to the basics, like the basic. Whenever you hear as a consumer that the rates are going up, they're talking about the Federal Reserve. Okay, so the Federal Reserve is basically the U.S. bank. It's the American bank. It is the Bank of the United States. Okay, so whenever you hear something about rates going up, it is like, or the Fed is raising the rates, right? What does that mean? Now, the Fed, we've been at zero just about since 2008, because in 2008, the economy crashed. There was a bunch of foreclosures in the market and all that. So the Fed lowered the rate, right, to produce stimulus in the economy. So there's 2 jobs of the Federal Reserve, okay, which is our American bank, right? One, the first job is to keep the economy stabilized, right? Up or down. So if inflation's going out of whack, it's their job to raise the rates so that inflation doesn't go crazy. So if inflation goes crazy, we can't keep up with it. The dollar weakens. You see bidding wars on houses. Have any of you seen where that people are buying houses for more than what they're actually valued? That's because people have too much money. There's so much money going around that people are buying in certain areas, and there's bidding wars happening. That weakens the dollar, and it creates inflation. Places like California and Florida really saw this horribly in 2008 because people were overbuying in the expectation that the appraised values would keep on going up and up. People were moving into the areas. People were willing to spend all this money, and then boom, everything crashed, right? Because everybody was able to get loans. That was a little bit different. Just there wasn't enough guidelines back then to stop people who should not have been buying from buying. But now we have all the guidelines. That's why some of you are upset sometimes because of how much paperwork we ask of you, which I don't want your paperwork. I have to have it though in order to get your loan approved with underwriting because we have guidelines to fulfill, right? So that's job number one, to stabilize the economy. If the economy is doing poorly, they lower the rates so to create business. If the economy is doing great and inflation, they're going to raise, or sorry, if the economy is doing poorly, they're going to lower the interest rates. They're going to lower the interest rates in order to create jobs. If you haven't seen my video about how many people it takes to produce a loan, there's something like 25 to 30 people just to produce one mortgage loan, just to do my job, just me. Now think about you as a buyer going to buy a home, then you've got movers, painters, furniture stores. You got to go to Target to get more cleaning supplies. You can go get more towels. Whenever you're doing a mortgage loan, and the rates are down, so more people are buying, it creates jobs and jobs and jobs. Even think about as small as like a call center. Like think about like Comcast, right? Where people are getting cable, more people are getting cable, then there's more people being hired in these call centers. I mean, just like it's everywhere. It creates so much stimulus whenever the rate's lower, right? That happened. The Federal Reserve has the hand in that and lowering those interest rates to create that because unemployment, right? So that's the second part. We'll wait on unemployment. Now, if the economy is doing well and inflation's happening, they're going to rise. They're going to raise the interest rates, which is what's happening right now. The economy is stable. The economy is good. So they're raising the interest rates, and they're still not high, by the way. Everything I quoted today was under 5%. The average is 6.5%. So rates are still very, very low, very, very low comparatively. So we just got spoiled with the threes and the 3% rates, in the last couple of years. That was a historic lows, like it never happened before. So get over it. Believe me, I want them back too, because when rates were good, I was doing more business. So yes, but rates are still very low. So when when the economy is doing good, like we are right now, they're going to raise the rates because we don't want inflation. Inflation's bad for us. So they raise the rates in order to keep as many buyers, consumer-wise, and banking and company-wise, from buying in or from being able to borrow as much money because it will stabilize it, right? It's just a constant dance of keeping it level. That's what the Federal Reserve is there to do. So that's job number one of the Federal Reserve. Job number two is to gauge unemployment, okay? So when unemployment is high, what do? Again, lower the interest rates. When you lower the interest rates, it creates what? More people, more companies borrowing money. So like I told you, there's 30 people in order to produce one loan. So think about how many more of those 30 people that we need, or assistance to those 30 people, all the movers, all the people, all the things, there's more velocity, right? There's more money moving around, there's more jobs. So when the unemployment, let's say, remember when it went up to like 11%, it was like, whoa, right? Rates dropped. So it sucks, but sometimes I wake up in the morning and if something bad happens to the economy, I'm running to work. Well, I'm driving because it's faster, right? But when bad things happen, unfortunately, it's kind of good for my industry because for the mortgage, because I know that rates are probably going to drop, which means I'm going to get a lot of calls that day. I better send out mass emails. Hey, if your rate is over 4.5%, call me right now. Let me quote you out. Let me see what's happening. Because when the economy does bad, rates are low. When the economy does good, rates go higher. It stabilizes, right? So keeping the unemployment at bay and creating that velocity is the stimulus of the economy. So those are the Federal Reserve's two main jobs. And that's why rates go up and down pretty much in a nutshell, right? That's the basis of it, right? So, keep in mind that, buying is good. Buying is good. Buying and purchasing things is good. And one of my mentors, Marshall Silver, he always says this too. When people buy, it's good for you. It's good for me. It creates velocity. It's good for the economy. And it's true. The more that money is working around, right, the better it is for the economy. You have to think about it so there's Federal Reserve, right, the big U.S. bank, right? So basically, the Fed controls us, right? But think about there's also another level of banks, right? There's actually 3 levels of banks, but there's another level of banks. We usually call them the big 4 in my industry. So that's going to be Citi, Chase, Wells, Bank of America, right? Kind of expensive to get loans through them. They do a lot of advertising. I'm looking at Chase sign right now, right? But a little bit more guidelines, whatever. But they are very important, right? Because they're depository bank. I'm a banker, I'm a mortgage lender, direct lender, right? But I'm not a depository bank, so I'm not taking your deposit. I don't have your savings account, right? But these banks do. So the excess reserves that they have at these big banks and why they're so important and for us as well is they're actually putting money into the Federal Reserve, right? So even our banks are moving money around with each other. That velocity is good for even our banking system. There's so many working parts. So the excess reserves, like your deposits and your savings accounts and things like that, are basically the big banks they're moving that up the chain to the Federal Reserve, and they're getting interest on that. So let's say it's a quarter percent interest. Whenever you go to the bank, you know how they're giving you extra incentive to, come park your money there. You have $100,000, you want to park your money there. The minimum for a certain type of bank account with no fees is like $25,000 or whatever. The reason is that they're taking those excess reserves in your savings accounts and things like that and parking it up into the Federal Reserve to make interest off of those excess reserves, right? Does that make sense? So money is moving around constantly. There's so many things, right? So that's why typically when the stock market is doing good, the rates are going to go low. When the stock market tanks, again, bad news is good news for me. It's terrible, but when like the other day, whenever we or a couple weeks ago, whenever we had the biggest stock plunge, which was like 1,000 points in one day, I was again running to my computer and seeing and waiting for a market change, a pricing for the better, because when stocks plunge, as an investor, think of yourself as an investor, and you've got money in the stock market, and you're watching the news, and you see that the stocks are going down. What are you going to do? You're going to run to your computer and you're going to take your money out. You're going to go sell off your stocks, right? Because you don't know what's happening. People are freaking out, right? Especially think about 2008, 2007 with the Goldman Sachs thing and all those things that happened, right? People freaked out, and the people like me and you are going in. We're taking out our money. Well, that makes it drop and drop and drop and drop. Well, as investors and these big time investors, they're going to go and they're going to put their money where? In the bond market. Okay. So the fixed rate mortgage, right? The 30-year fixed rate mortgage is tied to the 10-year treasury bond. So when stocks go bad, investors take their money out, they put it where? They put it in bonds. And one of these bonds is going to be called the 10-year treasury. There's a bunch of money in the 10-year treasury bond. Guess what happens to rates? Down. Right? Stock rates go down. Stocks plummet, rates go down, right? It's good for rates. So anyway, that is basically how that works, right? So let me see. Let's see. Okay. So another thing I want to talk about is what happens when rates rise. Rates rise. So think about this. When rates rise, it makes it more expensive for companies to operate, right? When rates rise, it makes companies more expensive to operate. Like, let's say, for example, let's say my office, right? When rates rise, what happens? I'm going to do a little bit less business, right? I'm still doing business. I'm still on this live telling you rates are still low. You still get time to buy. You know, we can refinance you later. We can do all the things, right? So, but when rates rise, it makes it more expensive for companies to operate, right? When it makes it more expensive for companies to operate, even like, let's say my office, right? I'm looking for what? Ways to decrease my spending. I'm going to move my office. I'm going to do whatever the case may be, you know, do whatever it takes to get my operation costs down. But when when the cash and the profits are not there, then it drives down the value of the stock, right? So if you have a major corporation, if there's less cash flow, it drives down the value of the stocks, right? So what happens when the stocks drive down? Naturally, because of rates being higher, people are then selling it. They're selling off, right? So the old bonds, and then what happens? So now the stock went lower. What I say happens whenever the stock market lowers. People are taking their money out, and they're doing what? They're putting it into the bond market, right? So then what happens? They're putting their money into the bond market, and maybe they had a 4% coupon then, right? But now there's 6% coupons. Why would they go put their money back in a 4% coupon? So old bonds now take a hit because there's new bonds to buy at such a higher rate with higher returns. So that being said, it's going to affect stocks, right? But here's the thing about stocks. They adjust, right? So whenever you see things going crazy and the news is going crazy about a volatile market and all that, why do you think that volatile markets and volatile times don't really last that long? Now, don't think about 2008, because 2008, even the bonds and the stock market adjusted quickly. It was the foreclosures, right? It's the foreclosures. It was the actual underwriting guidelines that did that. So a lot of people think that the 2008 deal had to do with rates and the stocks and the bonds. No, the stocks is because Goldman Sachs went out, right? We just talked about it was harder for companies to operate. Boom, stocks went down. The market's always going to adjust, right? Because the money's going somewhere. The money's not in the mattress, right? Well, some people actually call me and they really do have money in the mattress. We just had someone from West Virginia call and literally tell me that he had his down payment on his mattress. Literally, this happened like just recently, which is interesting. But most people don't have cash money, right? They don't have gold or silver sitting around. I do, because no, I don't have anything. Sorry, but most people don't. So the market is going to, if when the market is volatile, don't freak out. It's just people are going to adjust. Your money is going somewhere. It's going to bonds or it's going to stocks, right? The Fed, the big bank, is going to adjust the rates accordingly in order to, by watching what? Unemployment, inflation, right? So inflation goes out of control, they're going to raise the rates. Unemployment goes high, they're going to lower the rates in order to create velocity, create more business into the economy. So I hope that all made sense, because I was really trying to make this as clear as possible. And I want to practice this a little bit more and in talking about it, because I think it's very important. It's like really basic knowledge that if I go out on the street and I ask people, why do rates go up and down? There's no clue, and you should know that, because it's so that it doesn't create the fear. Like, the media is out there to create fear in you. You know, rates are going up, rates are on the rise, rates are on the rise. Whenever you hear that, that's the Fed. The Fed is bumping up the rate a quarter, a 0.25. Okay, it's not insane. It's not a big deal. It's really not. They're not raising. I hear all the time. Well, I mean, what if rates go back to 18%? Okay. That happened for like a few days in the 1980s, like a few days. Just that's it. So let's do this. Let's not refinance or buy in those few days. let's just do that. I would advise not to, because when people aren't buying, guess what happens? The economy is in trouble. Guess what the Fed's going to do? They're going to lower the rates. Why? Because it's creating velocity. It's always going to adjust. It's always going to balance out. Don't freak out. I guess at the end of the day, what I'm trying to say is don't freak out. Everything is a balancing act. Everything is a dance. Things get volatile. It balances back out, just like everything else that we do. So if you have any questions, please reach out to me. Again, DM me, put it in a comment. Email me, bwhitmire@financemyhome.com. You can call us, 214-660-5000. Those of you with my cell phone number, you can reach out to me there. If not, send me a text, 469-879-5949. I'm happy to help you. I'm here to help you. Please give me a call. And if you know anyone that I can help, please send them my way as well. And I will see you next week, Wednesday, 6 p.m. Central, for episode 32. I hope you have a good night.